Welcome to the Q1 2024 Fund Manager Report. My name's Harry Thompson and I'll be running you through today's presentation. There is a text version available at the news section of the website if you prefer to read that over the video. The anticipated bumps in the road after a resurgent end to 2023 were quickly felt at the start of the year, caused by the moderation of expectations for interest rate cuts after overheated expectations in the last few weeks of 2023. So far, the year has seen a mixed but essentially a more resilient global economy that has led markets to expect a much softer landing. Inflation continues to fall and employment remains resilient, which has led the market to take out a number of interest rate cuts, with expectations moving from around 6 to 7 rate cuts in 2024 to only around 2 to 3 by the end of the first quarter. US economic growth remains strong and the economy continues to perform in a textbook manner. Although US elections are due towards the end of the year, its isolation from Europe's war-related woes and energy independence remains a greater benefit. The energy price shockwaves that rocked Europe as well as the UK from the conflict are subsiding, but not without leaving scars. And the focus is now on the effects of the steep interest rate rises, which only finished in August 2023. In a turnaround from normal state of affairs, Southern Europe is growing. Spanish GDP grew at 0.6% in 2023, whilst the industrialised north continues to show signs of stalling. For instance, German GDP declined by 0.2% in 2023. In Asia, Japan continues to grow strongly, recently raising interest rates, as does India, which continues to slowly open to global markets. Against this, Chinese growth remains subdued, hampered by a burst real estate bubble, soft consumption, and lower global exports. One universal problem around the world remains high debt levels. The woes of Thames Water owner Kemble are creating headlines in the UK market. In China, it's two real estate giants, Evergrande and Bank. A number of European governments are having to rein in their budget deficits, and the debt ceiling has been a political issue in the US. It may be a legacy issue from COVID era, but there remains a view that deficits have not been reined in fast enough. And as money supply is continually drained by central banks, bond buyers can afford to be more selective. Fixed income retreated slightly in the quarter, and although long-term rates may fall again, once interest rates begin to fall, we do expect the curve to steepen. Because of this expectation that investors will demand a higher yield to hold longer-dated government debt, we still favour short-dated and high-quality bonds. Our portfolios sit around the 4 to 5 year mark on duration. Whilst not wanting to change this dramatically, where there has been weakness in yields, we have been able to slightly tick up duration, and this is something we did post-quarter end in our April rebalance. Even though expectations for lower interest rates remain in place, albeit further down the road than some had anticipated, the last move in the third quarter of 2023 were interest rate hikes. And this is still feeding through and impacting results and the cost of capital calculations for a number of interest rate sensitive sectors. In particular, infrastructure and property both remain under pressure, with the price discount to NAV remaining at record levels, NAV meaning net asset value. Even where we take a more cautious view on the NAV, we still see large discounts, and the boards of these investments remain under pressure to generate returns. In the first quarter, these investments and equity investments linked to them, such as renewable energy and recycling, gave back their gains and underperformed in the quarter. We have trimmed exposure to infrastructure, and some of the smaller investments remain a concern, but the larger investments are well managed, so we see recovery potential increasing once interest rates begin to fall, especially when cash becomes less appealing. In the short term, these investments gave up some of their late 2023 gains. In equities, global large caps continue to perform well. This is even after stripping out the outsized effects the Magnificent Seven continue to have on global equity indices. Once again, these 7 stocks, or Amazon, Apple, Alphabet, Microsoft, Meta, Nvidia and Tesla, they dominated performance. But towards the end of the quarter, as Tesla and Apple continued to struggle, we have seen this gap narrow. We have seen a number of large companies perform well in our universe, notably industrial names in electrification and healthcare where M&A has picked up. Smaller listed equities did lag large cap peers once again. However, we did see small cap names outperform in March, evidence of the broadening of equity market returns. Finding benchmarks for comparisons with regards to performance is difficult when taking both positive and negative screens into account. Even an ESG leaders benchmark has high exposure to the M7 stocks, of about 20%, and this distorts the ability to draw comparisons, given a number of those are outside of our universe. These benchmarks also have limited exposure to positive impact investments. Having multi-asset portfolios means a number of benchmarks need to be considered. Portfolios with a strong positive profile would be more aligned to an impact benchmark, and this was down around 2.4% for the quarter, whereas mainstream equities, including the M7, where there was no negative screens, were up between 3.5 and 10%. Real assets such as infrastructure and property and more future-focused investment profiles are more interest rate sensitive. Having weathered the post-COVID inflation surge and subsequently the conflict-related inflation, interest rate expectations remain elevated. Nonetheless, we are now more optimistic for a number of sectors, given forward earnings growth remains robust, while share prices remain under pressure. Many stocks in our universe have gone from trading at a premium to the general market to now trade at a discount. For example, a major global energy index trades on a 2025 forward PE of 14.5 times, compared to the wider market's 16.3 times. Whilst a basic measure of valuations, it highlights our point, given the previous wide premiums we had experienced in the post-COVID rally. We do expect a broadening of equity market returns outside of broad tech, which will benefit various equities in our universe, whether that's companies benefiting from a focus on global megatrends such as clean energy, or those likely to benefit from a rate-cutting cycle, such as broader small and mid-cap companies, as well as more cyclical and industrial names. Thank you for listening in to today's Q1 Fund Manager Report. If you do have any questions, please contact your King & Shackson representative.